a good time as any to get the market master for the day. Kenneth Andrade, Head Investment at IDFC Mutual Fund, joins us now. Good morning, Kenneth. Thank you very much for joining us. Well, for starters, what is the sense in the market itself? Do you think that most of the good news has been juiced out, and at least for the remaining part of 2014, we won't see too much fireworks?
The last 1 year, markets have been fairly favorable, fairly in favor of the investor, and you've got fairly high double-digit gains out there. While saying that, I think largely valuations are fair at this point in time, and there is a fair amount of execution that needs to be done to get profitability growth upwards. So that's a process that's going to take its time. So yes, I think it will be good if markets actually consolidate themselves around these levels before an earnings kick in 2015-16, before you can see some structural gains for an extremely long period of time.
Kenneth, hi, good morning. Thank you for joining us. I was just going through some of your sector allocation, and you have significantly raised stake in two sectors, in engineering and in autos. But these are stocks that have already run up considerably in the last 6 to 12 months. Are these still sectors that one should accumulate into now, or do you think you should move money elsewhere?
If you just look at the constituents of those two segments that we've raised exposures to, I think what we prefer to buy into are industries or companies which do not have significant amount of leverage, and where we see execution risks are reasonably low. So in discretionary spends, that's one part of the market one part of the industry that we think we will see near-term gains that would come through. And the other one, in terms of the engineering and cap goods space, I think there'll be incremental capex on the ground, and that should help these companies, both balance sheets, P&L accounts, as well as stocks should consolidate and give fair amount of returns from here.
Okay. Kenneth, when is the economy turning around? Should we look at that fabulous sales that Hero and Honda posted on Dhanteras Day as a signal of the economy turning around, or are these just good products that would get sold anyway? When are you actually looking at earnings upgrades coming in?
I think if you just step back again, 2013 is when the economy actually bottomed out. 2014, you got a new government in power, and there's been reasonable amount of initiatives taken by this government to actually make sure that the base will hold. So I think that's the first part of it all. To expect the economy to actually have a hockey stick kind of a recovery after a sluggish 3 or 4 years, I think it's not right to expect that at least in the near term. So let's see the market consolidate itself, let corporates get their balance sheets into place, let the banking system actually recapitalize itself, and I think 2016 and 2017 should be reasonably interesting as far as earnings are concerned.
Okay, Kenneth, actually in that context, let me ask you one of the questions posted on our money control message board. A gentleman, Ramakant Patnaik from Howrah, has written, he asks, what is your outlook for Hero Moto over the next 6 months? If you have constraints speaking on stocks, please speak on the two-wheeler sector.
Well, it's a fairly mature category, and I would not expect anything dramatic to happen from these companies, at least in the near term, or even significantly into the longer term. I mean, we need to look at companies that could buy into new markets and get their sales upwards, companies that get new products on the ground and get their pricing power up. So I think these are some things that you need to look for before you buy into categories like this. Mature markets, will not give you the kind of returns that you've historically got from this particular category. So if you're looking for returns based on the category has given you historically, I think it will be slightly misplaced, because categories like these have matured far, are usually the first ones to effectively mature out and become significant in the economy.
Okay. I wanted to ask you about the oil and gas sector, Kenneth, because it's not in your top 5 sectoral holdings right now, but last year you had exposure of more than 6 to 7% in that sector. Have you booked profits in oil and gas?
I mean, historically we've had a reasonable amount of exposure to the gas sector or the distribution space out there, and we've taken some money off the table. In the other part of the market, it's fairly regulated, and government's got significant amount of controls out there. So it's not really a free market economy that you're actually operating in. So that's one of the reasons why we've not been significantly overweight on that particular space.
Okay, Kenneth, if two-wheelers, from where we are getting seemingly good news, is a mature market and not the place to get alpha returns, then where should one look for big returns or outsized market-breaking returns? You appear to be the king of mid-cap and small-cap. What are the parameters to identify these outperformers?
I mean, what currently the market lacks is essentially category leadership or stock leadership, so as to say. So it's very difficult to identify one company that's going to actually pull this market through, or a category that's actually going to pull this market through. In 2005 to 2008, you had the entire investment economy that led the markets. If you step backwards to the turn of the century, you had IT that held through the entire environment. As the situation stands, we don't see that kind of category leadership that exists on the ground for the market. So if I have to build that into a portfolio strategy, I'd rather still go extremely company specific, but that's going to be a significant challenge when you run large size portfolios. But near term, that has to be done. Hopefully participate with the market till you identify that category leadership, and then actually ride with it. I don't think that category is actually showing up to give you some significant amount of alpha on the ground at this point in time. Companies might be able to do it, but when you run large portfolios, like I said, it's going to be reasonably tough to make it for it to show up
in spite of it,
you to let it show up in large portfolios.
Samvat to Samvat, and we've been crowing about this. The Sensex in the Nifty gave you 26%, but some of the mid-cap indices, depending on which index you look at, there were about 38% returns. How is the trend looking, here on? Will you continue to have this big outperformance from mid-caps?
I think you're looking at it from a point-to-point basis. So if you take from an all-time low to right now, yes, these indices have given you market-beating returns. But if you look at it from an entire cycle perspective, they've gone down that dramatically before they've actually bounced back. So to put it a little differently, these indices have come back from, and a lot of these companies have come back from bankruptcy kind of valuations to market level valuations. Which is what the market is essentially displaying at this point in time. There is no valuation arbitrage. There is no significant valuation arbitrage from an industry to an industry perspective. There is no significant valuation arbitrage even from a company to company specific. So if you have to build it forward, I think you have to. Any portfolio investor or any investor has to take execution risk on his portfolio, and make sure that the company actually executes into the future with more market share and higher cash flow and disproportionate profitability within the sector itself.